Imagine waking up, grabbing your phone, and seeing a headline that feels unreal. Something like, "A sitting president of a major oil-producing country has been captured." And your first reaction isn't political, it's financial. You start wondering, what does this mean for my money? My savings? My investments? The price of gas? The dollar? Crypto? Everything. Because deep down, you already know that when power collapses suddenly, money moves fast. Most people think events like this are far away, that they're political drama meant for TV panels and Twitter arguments. But here's the thing. When a president is removed, captured, or loses control abruptly, it doesn't stay local. The shockwaves hit currencies, commodities, markets, and everyday prices almost immediately. And if you've ever felt like global events mess with your finances even when you didn't do anything wrong, that feeling is not random. That's exactly what we're talking about today. I spend way too much time thinking about what happens to money when political power collapses suddenly. And if you're someone who's trying to protect your savings, invest smarter, or just stop getting blindsided every time there's a global crisis, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what's happening in Venezuela, and what could happen if leadership collapses or changes under US pressure, matters a lot more than most people realize. First, let's get something clear. The capture of Nicolas Maduro by the United States is now officially confirmed. What matters most is not the headline itself, but what it represents. A long-modeled geopolitical scenario becoming reality. A scenario where the Venezuelan regime collapses, its leadership is removed or detained, and the United States plays a direct role in reshaping the country's power structure. This video isn't about political opinions. It's about money, incentives, and consequences. Venezuela is not just another country. It sits on the largest proven oil reserves on the planet. Over 300 billion barrels, according to OPEC data. More than Saudi Arabia. More than Canada. More than anyone. On paper, Venezuela should be one of the richest energy nations on Earth. But production is a completely different story. At its peak, Venezuela produced over 3 million barrels of oil per day. Today, it produces roughly 700 to 800,000. Not because the oil disappeared, but because sanctions, corruption, mismanagement, and lack of investment destroyed the system. Oil is useless if you can't extract it, refine it, or sell it. Now this is where the United States enters the picture. Contrary to what many people think, the US does not hate Venezuelan oil. In fact, US refineries are specifically designed to process heavy crude, which is exactly what Venezuela produces. The conflict is not about oil scarcity. It's about political control and leverage. So imagine this scenario. Maduro is removed or captured. A transitional government is announced. Sanctions are lifted or eased. Foreign capital flows in. Infrastructure investment restarts. Production begins to climb again, slowly. That single shift changes the global energy equation. Here's what most people don't realize. Markets don't wait for things to actually happen. They move on expectations. When political power collapses suddenly in an oil-producing country, markets react within minutes, not months. Oil prices move. Energy stocks move. Currencies shake. And the dollar often strengthens temporarily as global money runs toward perceived safety. We've seen this pattern before. During the Arab Spring in 2011, oil prices jumped more than 20% in a matter of months. Not because production vanished overnight, but because uncertainty itself is expensive. Markets price fear before reality. And this is where psychology becomes more important than math. During geopolitical crises, most people panic. They sell at the wrong time. They freeze. Or they chase headlines instead of understanding second-order effects. Meanwhile, large investors do something very different. They don't ask whether a situation is fair or moral. They ask where price is disconnected from future probability. This is where it gets really interesting. Crises like this don't just destroy value. They also create it. But only for people who understand how money moves under stress. Oil is the first domino. In the short term, prices often rise due to uncertainty. In the long term, if production increases, prices may fall. That tension creates opportunity. But the real opportunities are rarely obvious. It's not just buying oil. It's companies that service oil production, infrastructure firms, transport, refining, countries neighboring Venezuela that benefit from trade shifts, even deeply discounted bonds that markets have already written off. At certain points in history, Venezuelan sovereign bonds have traded at 10 to 30 cents on the dollar. If political change becomes credible, those bonds don't need perfection to double or triple in value. They just need survival and restructuring. Now you might be thinking, this sounds incredibly risky, and you'd be right. But here's the distinction most people miss. Volatility is not the same thing as risk. Volatility is movement. Risk is not understanding what you own. Most people confuse the two and end up avoiding opportunities they don't understand while taking hidden risks they never see. Let's talk math for a second. Imagine you have $10,000. You allocate $8,000 to stable assets. and $2,000 to asymmetric opportunities tied to geopolitical shifts. If the worst happens, and that $2,000 drops by 50%, you lose $1,000. But if political change triggers a repricing, and that $2,000 triples, you gain $4,000. That's not gambling. That's asymmetric risk management. That's how institutional capital thinks. Now zoom out. When crises like this hit, the dollar often strengthens. Emerging market currencies weaken. Inflation gets imported into everyday prices worldwide. Even if you live far from Venezuela, global commodities are priced in dollars. That's how this reaches your grocery bill, your rent, your fuel costs. The biggest driver here isn't news. It's collective psychology. Markets move based on shared expectations. When the narrative shifts from "nothing will ever improve" to "this system might unlock," capital moves before confirmation arrives. By the time certainty appears, the opportunity is gone. History is full of these moments. Iraq after regime change, Libya before and after Gaddafi, Iran during sanctions negotiations, chaos, collapse, repricing, reconstruction. It doesn't always work, but when it does, it's explosive. So what can you actually do? First, don't make decisions during the first wave of panic. The first 48 to 72 hours are noise. Second, watch what rises quietly without positive headlines. That's institutional money positioning early. Third, think in second-order effects. Not Venezuela, but who benefits if Venezuela stabilizes. And finally, define your risk before you enter, not after fear takes over. The most important mental shift is this. Most people see crisis and think danger. People who understand money see information, not blind optimism, not paralyzing fear. Clarity. Events like this don't separate rich from poor. They separate prepared from reactive. This isn't about politics. It's about understanding how money flows when power changes suddenly. If this video helped you see money with more context and less fear, make sure to subscribe. Leave a thumbs up, and I'll see you in the next one. Because understanding the system is the difference between being crushed by it and using it to your advantage.